Welcome to a journey that will transform your understanding of the financial world. Today we're embarking on an exploration of the acclaimed book, A Random Walk Down Wall Street, by the esteemed economist Burton G. Malkiel. A titan in his field, Malkiel's work has shaped many of the financial theories and practices we see today. His book, now in its 12th edition, is considered a must-read for anyone interested in finance, offering a blend of investment advice and economic theory. Through his insightful analysis and knowledge, Malkiel guides us through the labyrinth of the financial world, simplifying complex concepts and theories along the way. His work has been lauded for its accessibility, making the often intimidating world of finance easily understood by all. As we delve into the chapters of this insightful book, prepare to have your financial perspectives broadened. So, are you ready for a random walk down Wall Street? The book begins by presenting two investment theories. The firm foundations theory posits that the value of a stock is determined by its intrinsic worth, calculated using metrics such as dividends and earnings. A prudent investor, according to this theory, should calculate this intrinsic value and compare it to the stock's current price, buying when the price is low and selling when the price is high. On the other hand, the castles in the air theory suggests that the value of a stock is not determined by its intrinsic worth, but by the public's perception of it. Here, an investor's goal is to anticipate what others will find attractive and buy before the crowd does. The author emphasizes the importance of understanding investor psychology in both theories. The firm foundations theory requires an understanding of how investors perceive value, while the castles in the air theory necessitates an understanding of crowd psychology. These theories set the stage for the rest of the book, providing a necessary foundation for understanding financial markets. Chapter 2 takes us through the history of speculative bubbles. A fascinating journey into the past, it highlights the power of mass psychology in shaping economic events. We revisit the infamous tulip bulb craze that gripped 17th century Holland, where prices for a single tulip bulb soared to dizzying heights, only to crash spectacularly. Malkiel then transports us to 18th century England, where the South Sea bubble painted a similar picture of runaway speculation followed by a devastating collapse. These historical episodes, Malkiel posits, are not mere anomalies. They are cautionary tales, illustrating the intoxicating allure of herd mentality in the world of investing. He delves into the psychological factors that fuel these bubbles, from overconfidence to irrational exuberance, and our propensity to mistake luck for skill. This chapter leaves us with a stark reminder of the dangers of following the crowd in investing. It underscores the importance of independent thought and rational decision-making in navigating the turbulent waters of the financial markets. The third chapter takes us on a journey through 3 decades of stock valuation. Burton G. Malkiel, in his insightful book, A Random Walk Down Wall Street, diligently explores the dramatic shifts in stock market trends from the 60s through the 90s. In the 60s, the stock market was characterized by a sense of optimism and confidence. Investors believed in the Nifty 50, a list of 50 popular large-cap stocks considered as one-decision stocks because they were viewed as extremely stable, even during market downturns. But Malkiel reminds us that this period was not without its pitfalls, as the over-reliance on these one-decision stocks led to an inflated market and the eventual crash in the early 70s. The 70s brought about a new era of skepticism and caution. The decade was marked by high inflation and economic uncertainty, causing the stock market to become volatile and unpredictable. Investors were forced to adapt their strategies, focusing more on value investing and less on growth stocks. In the 80s, the market experienced a shift towards a more global perspective. The rise of multinational corporations and the increasing ease of international trade influenced the stock market greatly. This era was also marked by the advent of technology stocks, which would revolutionize the market in the years to come. The 90s saw the birth of the dot-com bubble. Internet companies were the new Nifty 50, and the market was once again characterized by extreme optimism. However, as Malkiel points out, this led to another market crash when the bubble burst at the turn of the century. Through his analysis of these decades, Malkiel emphasizes the cyclical nature of the stock market. He demonstrates how investor sentiment economic factors, and technological advancements have continually shaped and reshaped the market landscape. This chapter provides a historical perspective on stock valuation, highlighting the importance of understanding market trends. It serves as a reminder that while the stock market can offer great rewards, it can also pose significant risks if not navigated with knowledge and caution. Chapter 4 introduces us to the world of professional investing. In this fascinating realm, the stakes are high, and the players are some of the sharpest minds in the world. But even in this elite league, Burton G. Malkiel draws our attention to a startling revelation. The professionals, for all their knowledge and expertise, may not necessarily outperform the market consistently. Malkiel dives deep into the strategies and tactics used by these financial wizards. From complex algorithms to gut instincts, from historical data analysis to future predictions, the tools of the trade are as varied as they are intricate. Yet despite this arsenal of tactics, the author highlights a sobering truth. The financial market, with its myriad variables and unpredictable swings, isn't easily tamed even by the most seasoned professionals. The author goes on to dissect the myth of the infallible professional investor. He presents a compelling case backed by hard facts and data, challenging the notion that these experts can consistently beat the market. In fact, he argues, a significant number of professional investors tend to underperform market indices over the long term. Malkiel's skepticism extends to the fees charged by these professionals. He points out that the high costs associated with professional management often erode the returns of the investors. He argues that, in many cases, a simple, low-cost, broad market index fund could yield better results. In this chapter, Malkiel's message is clear and thought-provoking. He urges us to question the conventional wisdom about the superiority of professional investing. He encourages us to scrutinize the claims of consistent outperformance, to consider the impact of high fees, and to think critically about the value that professional investment services bring. Through this exploration, Malkiel invites us to see the world of professional investing in a new light. He prompts us to question, to analyze, and above all, to make informed decisions. Malkiel challenges us to question the conventional wisdom about professional investing. The final chapter presents a new tool for the modern investor. Let's delve into the concept of the index fund, a brainchild of Burton G. Malkiel that has revolutionized the investment landscape. The author paints a vivid picture of this ingenious tool, a cost-effective and efficient way for individuals to invest. Malkiel fervently argues that by investing in an index fund, an investor essentially buys a small piece of the entire market. This strategy provides diversification, reducing the risks associated with investing in individual stocks. Additionally, index funds are passively managed, which means they have lower fees than actively managed funds. Malkiel's advocacy for this tool is underpinned by his belief in the random walk theory, asserting that stock prices are unpredictable and follow a random path. Therefore, he suggests that the best way to beat the market is not to try to outsmart it, but to simply keep pace with it. This chapter concludes the book with a powerful tool for individual investors seeking long-term growth. As we conclude this journey, let's reflect on what we've learned. Our exploration of Burton G. Malkiel's A Random Walk Down Wall Street has been quite a ride. We have navigated through the world of finance and investing, delved into the history of speculative bubbles, and examined the trends in stock valuation. We started with the firm foundations and castles in the air, two contrasting investment theories. The first theory, firm foundations, is based on the idea that a stock's value is firmly grounded in its intrinsic value, which can be calculated through fundamental analysis. The other theory, castles in the air, posits that an investor can profit by buying securities that are currently popular and selling them when they are no longer in vogue. Our journey through the madness of crowds took us to the history of speculative bubbles, a phenomenon where the price of an asset exceeds its intrinsic value due to excessive demand. We looked at the infamous tulip mania of the 17th century, the South Sea bubble of the 18th century, and the dot-com bubble of the late 20th century. We then explored the changing trends in stock valuation from the 60s through the 90s, understanding how valuation techniques have evolved over the decades. We saw how the rise of technology and globalization has profoundly impacted stock valuation. Next, we delved into the strategies employed by professional investors in the biggest game in town. From market timing to value investing, We discovered how the pros play the financial game. Finally, we introduced the concept of the index fund, a new walking tool for the modern investor. A simple and cost-effective way to achieve broad market exposure. Index funds have revolutionized the investment landscape. We hope this summary of A Random Walk Down Wall Street has given you valuable insights into the world of finance and investing. Remember, the journey to financial knowledge is a never-ending one.